So for those people who don't know me yet, my name is Art Bjorn, and we originally hail from California. We moved here about 7 months ago, and it's because of this business. I used to work as a skilled nursing facility business manager, so we have a good income. I have a good income back then, but you know, it's really different. Like, we're celebrating Memorial Day tonight, right? I mean today. What type of memorial would you want to have when it comes to passing away? So with me, like I really want to leave a legacy to my family, not just in terms of leaving them a house, giving them some money, but a foundation where they could continue to thrive. And I wish you also wish the same for your family as well. Like a lot of people, we've been busy working and working and working, and I don't know if you're really saving money. So that is why we really focus the business on helping people how to build a financial foundation. So with myself, in my case, like we have income before, but I have a background in accounting. I also have my master's in business administration. But it's different if you're handling your actual life or your actual money. It's easy to handle other people's stuff, right? Like there was a time where we used to deal with teachers, and for some reason I thought teachers, they have really good, smart kids. But apparently they don't have one. You know why? Because they're so busy teaching other people's kids. It's the same thing with doctors. I'm sorry. No, but that's the thing. Like, you get so busy treating other people's illnesses, but you get to forget about yourself. Are you healthy? Right? So it's the same thing. Does that make sense?
Yes.
So,
Yes,
so it's a psychology that keeps on happening. And that's why we want to reiterate on, this part. Financial security is not a dream. It's something that you need to prioritize. Agree? Okay, so let's move on. So we would usually teach people how to basically plan for your future. A lot of people, when you ask them, like, let's say, Mike, when do you plan to retire?
Like now, 50, 60
See, you would get the same response. Like when you ask someone, when do you want to retire? Maybe Adam, when do you want to retire?
50.
See? Very few people can answer you right away. I want to retire at age 40. I want to retire at age 45. Why? Because they're so confused. They think that retirement is a concept of you not working when you get to 65, when you get to 70 and a half. Why? Because that is where people can access money, can access the Medicare, can access Medicaid. But actually, in reality, retirement is anytime, right? But the thing is, can you afford to retire? Do you have the resources to retire? Right? So, with this example, let's say you're age 40. Let's say given a client at age 40, you ask them like, when do you want to retire? Let's say, Jose, when do you want to retire? And then he said, okay, I want to retire at age 60. So given the 40 years old and the 60 years old, which he plans to retire, so the age is 40, he wants to retire at age 60. That means he still has about 20 years to save. But the question is, are you going to be religiously saving money for your retirement? Why? Why do you need to pay attention to this? Because in the United States, we have a lifespan of about up to age 85 on average. So let's say you're lucky enough to last until 85, but because of the advancement of medicine, it could go to 100 years old. I've seen people who reach 102, 103 in the facility. And what if it was you? And you're left with 20 years to save. What are you going to do? So let's say at age 40 wants to retire at age 60, so you tell them, oh, you only have 20 years to save. For what? For the next 25 years that you're going to have no job. Clear? Okay. So given 25 years of retirement, what did I say? No job. So you're basically depending on what? You're lucky if you have the 3 legs of your stool. Let's say you have your own personal savings. We still have Social Security. And what's the last one? If your company offers pension. So what if your company doesn't offer pension? What if Medicaid is already exhausted? And what if you don't have any savings? What's going to happen to you? So it's a mystery, right? And you don't want to be in that situation where you can do anything. That's why I asked you earlier, what kind of memory would you want to leave to your family? Having those three would keep you stable, would keep you in a more dignified life. Okay? So let's say this guy, save for the next 20 years and then save up for the next 25 years. So let's say the next question is, okay, Eve, how much do you want to have every month when you retire? Do you want it the same as what you're getting right now? Do you want to downgrade because probably you've already paid up some of the stuff that you need to pay? Or you want to upgrade because you want a better lifestyle? Upgrade, right? But for you to afford to upgrade is what? You need to save up some more money. Alright? So if you want to upgrade, then how much, like a ball figure, do you want per month? About 10,000, about the same? Okay, so let's just use this as an example. So this 40-year-old wants to have at least $10,000 every month as an income after they have work, okay? So the 10,000, you have to multiply it to 12 months so that you can get how many, like a year worth of income. So for you to get $10,000, then you need to save up $120,000 for you to get that lifestyle that you want. So that's $120,000. But then you're going to be living in the next what? 25 years. So you multiply 120,000 times 25, and that's about $3 million. In Texas, that's huge, right? But what if you're in California? What if you're in Hawaii? What if you're in New York? Right? But we don't know yet. We don't know what's going to happen with the economy. You know, there's also the factor of inflation. We don't know if $3 million would be enough. You know? So typically, a person, for you to really survive for your retirement, is you making at least, what, $1 million to $1.5 million. And now the question is, are you even halfway? Or are you even 1/4 of it? If not, then the more need for you to be in this type of what? Business. Okay? So, for this person, for him to be able to save up this $3 million, they need to save up about $5,000 every month. Why is it too big? Because you must look at this concept where you bought a house, maybe $3 million, right? How much mortgage do you think you would be paying for that house? It's probably the same amount of money. So it's the same concept with you saving money. Does that make sense? Okay. So you want this, then you save this every month. If you can't afford to save $5,000 every month, then at least try to save half of it. If you can save half of it, then at least try 1/4 of it. If you can save 1/4 of it, then at least try. You know, even if it's $25, if it's $50, if it's $100, you gotta try. It's a habit. It's a discipline that you have to make. Okay. So like with us in the beginning, it was tough for us to really save up money. But you know, because you hearing this concept again and again and again and again, you know, slowly you're going to love it. You know, it's not going to be easy, but it's a process that you have to undergo. Any questions on this? Clear enough? And actually, you could do it on your own, and then you could get this. Actually, this guy's lucky because he's getting about 8%. What if you're just saving up $5,000 and no interest? Then that's going to take a while for them. Okay? So I'll just give you a little background of the company. So we're a family of Transamerica. Now WRL merged with Transamerica in Equitable Life of Canada. And we're partners with ING which is now Voya, Jackson Life, Pacific Life, Allianz Nationwide, and a lot more companies out there. We're affiliated with about 150 companies in the financial industry. Alright? So who we are, we're a World Financial Group, a financial services marketing organization. So we're not an insurance company, we are a brokerage, okay? So our vision is to build the best and largest financial services marketing organizations. And our mission is to help families build and protect their wealth, and that's through the powerful solutions for building a successful business. So again, we are not an insurance company, we're a brokerage. So we help insurance companies and we also help clients find a suitable financial product for them. Clear? Okay. So what is your personal situation right now? So do you have problems paying your bills? Are you concerned about your job, your career? Because this was me before. You know, I worked for the medical industry, for the health industry. You know, a lot of people think that, okay, it's going to be a stable business. But because every year we've been getting a lot of changes, right, in the policies, in the regulations, you know, with the rehab and all this stuff, you know, because usually in our case, it's a skilled nursing facility, so we get paid based on the level of care that we give to our clients. Same thing with the home health industry. But you know, if there are a lot of changes going on, then my job, if I don't continue to update myself with all these changes, then I'm gonna be obsolete, right? And it's not very cheap. A seminar that I have to attend would cost me about $3,000 for 4 days. So it's basically like you going to school. So, you know, your career. When I was working with them, I quit my job about 2.5 years ago, almost 3 years now. I joined the business 4 years ago. I was able to quit my job 15 months in the business. So I was able to do that because I have a strong urgency. I don't want to be in a situation where, you know, I've seen a lot of elders and not all those elders are being visited by their kids. Or, you know, I don't want to be in a situation where my mom is also growing older, right? And I don't want to be in a situation where I get stuck in my job, you know, they only give me maybe a couple of days off or maybe a week off to see my mom, you know? I want it to be like, okay, if I want to visit my mom, then it has to be on my own time. So that pushed me so hard to really do the business and then get out of my job, you know? And I don't know if it's going to be, Adam, are you going to be excited to work for the next 30 years?
No.
Doing the same thing? Right? So I just opened up my mind, you know? The only thing that helped me here is my common sense, you know? I've seen people have made it. I'm not saying that it's going to be easy, but there's a path that you have, that they already have in place for you. All you have to do is just follow. It's the same thing. When you go to college, right? When you start going to a job, you get to an orientation. You still prepare. They don't just like, okay, I'm going to throw you there, right? And then do the job. It's going to be the same thing again and again. It's just a matter of looking at things in a different perspective, right? Like me, I already know what's going to happen in the next 5 years if I'm still working with them, right? I'm already seeing myself like working for them in the next 10 years. But this opportunity came to me. And I don't have any idea if what's going to happen in the next 5 years, in the next 10 years. But I gave it a try. And it worked for me. So I didn't lose the opportunity of, you know, making it to the business because I said yes. But if I said no, do you think I would be here right now talking in front of you? Of course not. So just give it time, you know, ponder about it, think about it, if it's something for you. At least you don't lose the opportunity of maybe it will work for you. So are you paid what you're worth? Wouldn't it be nice if you're paid based on the effort you make? Right? Not by the time you put into your timesheet. Do you think you're worth $20? Do you think you're worth $15, $40, not even $100, right? So you put value to yourself. You have to think about how much you're worth, and then start building your legacy. Okay? So are your children growing up and parents growing older faster than you can provide for them? So it's good if you're only taking care of your kids. But a lot of households, some of them, they still have to take care of what? Their parents. And actually, that's one of the main causes of what? Bankruptcy in the United States. Because you have to take care of your kids, if they're into college, and then you have a mom who's ill, who didn't save. Now, how are you going to get out of that situation? Everything you can get out of it through what? Preparation. So you really have to save up, because life is never going to be easy. Then do you feel your financial trap is affecting your family? Is life passing you by? In Texas it's so easy, because it's very slow paced in Texas. In New York, in San Francisco, you have to run, you have to really fight. But here, because of the lifestyle, of the community, because of the culture, then this makes you pass by each day. And then do you still have hope for a brighter day? So you may be in this situation, then good if you're here. If you're not, then at least you probably would know someone who's in this situation, then you could probably refer this community, this facility to them. So at least we could help them. Because this is something that we do for free. It's like an actual business school for you. Alright? So one of the greatest discoveries of the 20th century is that you change your life by changing the way you think. So it's all about your perspective. If you say you want to change, then do something new. Don't do the same thing again and again and again. That's why I said, I don't want to be in that job for the next 5 years, because I already know the outcome. They probably would give me what? Maybe 1% or 2% raise. But I'm not going to be expecting what? 100% increase of my salary. Okay? So money basics. So these are some of the concepts that we teach people. And that is something that you will see in the book. Okay? So, first is you, of course, need to know your challenges. To protect your family, what if something happens to you prematurely? What if we die too soon? What if we get sick? What if we're walking outside and then a truck hit us? That's a challenge, right? Next is to reduce your liabilities and get out of debt sooner. So who among here doesn't have any debts? No one? Okay, I need to pull. Yeah, that's good. So you have a challenge. And me too. And then dealing with constant changes in your job, career, or business. Right? So a lot of people, you have a good job right now, but are you okay in the next 5 years, 10 years, 30 years? What about a business? A lot of people, they would resort to putting up a business because why? They can cope up with a job. But being in business is not easy either. Because you have to what? To really prepare. And then living a long life without adequate income. So it's okay if you're only living up to 85. What if you're extended to age 90? What if you're extended to 100? Because they will try to what? Revive you here in the United States. Oh, my mom doesn't want to die yet. So keep her alive. Then comes another 5 years. Oh my gosh, I'm going to lose her. Keep her alive. Then another 105. They're actually seeing kids born right now. Oh, lucky you, because there's a baby in the back. They said that they'll live about 120 years old. 3 of them, who's born in this era, would reach about 120 to 150 years old. So lucky us if we die too early. If not, then what are the solutions that we can provide for you? Okay? So, like building a house, you must see your financial house as how you are building your own house. Okay? It has to start with a very, very good foundation, which is what? Protection. Why? Because you want to cover this. What if something happens to you prematurely? What if you get sick? Would you want your family to pay for it, or you have established something that will pay for it? Right? So this will answer this problem. Then the next level would be what? If you get yourself protected, when we talk about protection, it's you being insured. You know, you insure a lot of stuff. Your car, your house, but what about yourself? So, when you get protected, of course, the next thing that you have to manage is what? Your debt. Why? Because you want to leave your debt, you know? You want to get out of debt sooner as possible. And how you do that? Do you have any plans? So as a company, we offer workshops that can help you, you know, get out of debt. But of course, it's through your own efforts. We'll just be your guide. Because it's going to be you managing your own debts. But at least you get the foundation from this institution. Okay? And then, when you're out of debt, what comes out? More money, right? So, you have to establish an emergency fund. Why? Because you want to answer this problem, this challenge, which is dealing with constant changes in your job, career, or business. Right? We would always advise people to at least save 6 months of your monthly expenses, or at least your income. You know, if you, let's say you're spending about $1,000 each month as a family, right? You multiply it by what? 6 months, which is $6,000. You need to have at least $6,000 saved up. For what? Emergencies. So that maybe a layoff would come out, then you're not too desperate to get the first job that will come out, paying you maybe $750. You know, you don't get desperate getting the cheapest wage because you have some money. You have extra money. You still have means to survive. That's why emergency fund is very, very important. Okay? So keep that in mind. If you don't have any savings yet, any forms of savings, then at least establish an emergency fund. But of course, protect yourself first. Then manage your debt. And then we go on to what? Because you have already established your emergency fund, then more money is going to come out, right? So that's the time you're going to invest your money. Why? Because you want your money to work for you this time. You want your money to keep growing so that you can use it for what? For future expenses. Okay, so what's typically going on with majority of the people? It's happening like the other way around. Like a lot of us, when we started here in the U.S., because we're immigrants, a lot of immigrants, they see a house as a lifelong dream, right? So people, because they're too excited to purchase a house, then they will buy the house, right? When you buy the house, oh, what happened? So when you buy the house, people will think that it's an investment, right? But is it really an investment? Okay, when you buy the house, is it an asset for you or a liability? Why? Because you're going to pay a mortgage, right? So what did you do to your debt management? You added a 30-year debt to your debt. Good move or not? Okay. So, most of the people who would purchase a house would need to pay what? A down payment. So what do you think are they going to use for that? Emergency fund. And what if the family is not protected? What's going to happen to the people residing inside the house? They have to leave the house, right? If something bad happens to the person paying the house. So you have to establish your financial house properly. Get yourself protected to answer this problem, properly manage your debt to solution this problem, and then emergency fund, you know, for you to be able to deal with the constant changes in your job, career, or business, and then living a long life is through investment. Very simple slide, right? But very, very powerful. Okay. So for those people who don't have money, then this company will teach you how to make money through you being in business. Of course, for those people who already have money, then we are a company that will help you save money. If you have some money saved up, then we'll teach you how to grow that money, and then at the same time what? Protect your money. Okay? Okay, the next concept that we're going to talk about is the X curve. Very simple. Younger, older. This is basically like the timeline I showed you earlier, right? We are younger and then we grow older. So there's two types of curves in life. the blue and this gold curve. The blue curve is your responsibilities. Okay, so your goal is to what? Get out of debt sooner, so you have to bring this down. And then, law of building wealth is this gold curve. So your main goal is to keep a big gap between your wealth as the top and the responsibility is down. For you to what? To be generally secured when you retire. Because if not, then you're going to be on this side. If you're going to put a line here in the middle, where do you see most Americans? Or at least see yourself. Do you see yourself in the middle already? Do you still see yourself here? Or do you see most people on this side? Alright, so you have to assess yourself. Where am I at? So if you're still on this side, then the more you need to attend more trainings here. The more you need to attend more workshops, so at least you get to practice it. Because why? When you're younger, typically, you'll be what? You probably would get hired, and then, of course, maybe get promoted for an extra income. But because of that, you know, your responsibilities also grow. Because why? Most people would, okay, an extra raise, they will travel right away. Or they will purchase a new purse, or they will buy a new car. So this keeps on piling up, until you're gonna be drowning in debt. It's gonna be a trap for you. So your goal is what? Our company as a goal is, we want people to transition from this side to this side. But we want it for you to do it first to yourself, you know? We want you to transition from this side for you to have a generally secured future. Because wouldn't it be nice if you have kids, right? Be born without any liabilities and then you have a lot of money. Do you think your kids will love you? If they were born like that, right? So, it's a matter of perspective. How do you really plan for your life? Because a lot of people, they see institutions as, you know, they just go to a doctor when they ill, right? But a lot of people have money problems, but they don't want to go to money doctors. And why? Because there's not a lot. That's the thing. Like you see this room here, how many are licensed? Maybe not even half of the people here. And that's why we need more people to what? Share this information to a lot more people out there. Because the community needs some kind of information with what? About saving money, you know, investing. So you must take care of your responsibilities while building wealth. So in order for you to also realize the value of, you know, building wealth is for you to know the formula of wealth. So anybody familiar with the formula of wealth? It's quite simple. Very good. So Francine, if you have money, you need time for your money to grow. Very simple. And then you need a good rate of return for your money to grow. Because the rate of return could also be negative. So it could be a rate of what? Turn back or something. A rate of no return. Right? Because there's a negative. And then what's against your money would be inflation and taxes. So if there's two things certain in life, it would be what? Debt and taxes. So that's how you can build your wealth. So let's dissect this for you to understand it better. So let's say we have two types of people. Mr. Start Early and Mr. Wait Longer. So this person saves about $3,600 every month, right? So $3,600 every month is how much? I mean every year. How much if you break it down to a month? How much is it? $300, right? So if you break down $300 per day, how much is that? About $10 a day. Okay. Is it big? Right? So this 25-year-old realized to save money when he was 25 years old, doing it in the next, for the next 7 years. For 7 years, he did it with an 8% tax-deferred account. Tax-deferred is something you're not taxed right now, but later on they're going to tax you. But at least, you know, it's helping you write off some taxes, right? So for the next 7 years, he was able to contribute about $25,200, whereas Mr. Wait Longer probably said, okay, I'm 25, I just got married. 26, oh, I'm having a baby. 27, oh, we're buying a new car. 28, or I'm buying a new house. You know, they keep on procrastinating until he realizes to save up when he's 32 years old. Saving the same amount of money. Look at the total contribution. It's 61,200, right? So, the total accumulation, look at the difference between the contribution and the accumulation. Are you wondering why it's, there's a big difference here, but this one, there's not much. And it's because why? Because, you have any idea, Luis? Because this, Mr. Start Early, gave his money what? Time. You see this? 32, 33, 34, 35, 36. So that's the time I was talking about. Even if you don't save as much money, as long as you give your your money to time to grow, then it will accumulate faster as somebody who's catching up. So the lesson here is it's always good to what? Save up money when you're maybe Suwad's age. Right? How old are you, Suwad, if you don't mind? 20? Okay, you need to start saving money because this guy started 25. You know? So, I'm jealous. So, 25, and then this guy, the other lesson is it's always not late to save up money. All you have to do is what? You have to catch up. You have to play catch up. Okay? So, the important lesson here is what? To pay yourself first. Because typically, people would get their paycheck and then what? Go pay Macy's, HEB, Walmart, and then whatever is left, you save it, right? Why not make it a habit that you go out, get your paycheck, save up some money, maybe pay yourself maybe $200. Do you think you're worth $200? Or $300? Right? Or more than $300. Then you need to give some more money to yourself. Why? Because you need time. You need to make time as your what? Friend. As your best friend. Because if you lose time, it's going to be hard for you to what? Catch up. Because you have to double all the money that you have to save up. Okay? So procrastination is one of the main causes of failure. So small changes, big money. A lot of people will say, oh, $10, it's hard. It's so hard to save that in Texas. Why? Because our minimum wage is how much? In Texas, about $7.75? $7.95. Okay. I'm not getting $7.95 an hour. But actually, for somebody who's working, do you really spend 8 hours working? Don't you have a coffee break? Or, in the morning you'll chat with your coworker for maybe 10 minutes, and then the next 30 minutes you're gonna just browse the web. Right? Wouldn't it be fair to give yourself the first $10 that you make? There are things that you can cut down if you're only making 7 something, but you're working for the whole day. You're working 8 hours, so at least in a day you could probably get more than $10. So what are the things that you can cut? Maybe soda, cigarettes. If you're going to Starbucks every day. Actually, you just read an article about Starbucks. It's not actually Starbucks. The culprit is not Starbucks. It's actually yourself. Because you don't save and then you pay Starbucks. Right? And then games, bottled water, sweets. Why sweets? Or cigarettes? Any idea? Because we want to keep yourself healthy. Because the more healthy you are, the more you're going to save money. Agree? Because you don't have to pay the doctor. Because if you don't have insurance, then you have to pay the whole thing. So you need to keep yourself healthy as well. Alright? And then shopping, driving a big car. I think it's okay in Texas because gas is cheaper. But it's a no-no in California. And plus there's no parking. So eating out, of course, partying. Right? Liquor, right? Partying. Why partying? You go out, you pay gas. If you're going to a birthday party, you have to buy a gift. Right? If it's a potluck, then you have to buy food. So think about it. Just imagine a $300 that you save every month at 8% interest in 30 years. So what? If you started saving $300 right now at 8%, at 30 years, you probably would get about $500,000. Excited? But you need to save up $300. You have to pay yourself first $300 every month. And then what if you're a couple doing it? Then that's close to $1 million savings for you. So did that help you putting up a good future for your family? Right? So it's all about what? Discipline and consistency. Okay? So you pay yourself right now, like every month, but next month, oh, maybe this is too big. Maybe I'll just do $50. And then you go to the next month. So it has to be fixed, you know, it has to be a fixed amount every month. Okay, I have to pay myself first. I have to pay myself first. Okay, say it. I'm paying myself first.
Paying myself first.
Okay. Alright? Not I'm paying my wife first. Because sometimes it has to be yourself first before your wife. So at least if something happens, then do you have some hey wives, you have to understand it. What if they give everything to you and something happens to you? You got broke, you know? So at least your husband can pull out something, you know? Give them at least maybe $50 or $100 every month. Fair enough? Okay, so going back to the interest, you know, the rate of return. A lot of people, this is a very, very wonderful slide. Why? Because we're talking about the rule of 72. It's an Einstein rule. You know, it's being used by a lot of financial professionals. 72 is a constant number. Let's say, who's banking here? Bank of America, Wells Fargo, Chase, bless you. Okay, everyone has money in the bank, right? Do you have an idea like how much a bank would pay you for the money that they're using? Right? So you just want to put your money there and then have them use your money. And you don't care how much they're going to bring you back. Okay? So let's just say a bank would give you 4%. And then for people with 401k, who has 401ks? 403bs? Okay. So let's say a good rate of return about 8%. And then for those people who probably would know how to play stocks, then they get a higher rate of return, maybe 12%. So given the rate, you divide 72 by that rate, then that gives you the amount of years your money is going to double. Okay? So let's say this person, 29 years old, 3 people, has $10,000 to save at 29 years old. But the difference is the interest, right? So given 4%, 8%, 12%, this person, his money will double in 18 years. This person, his money will double in 9 years, 6 years. So 29, 47, 65, by the time he retires, he has $40,000 for a $10,000 save up at a 4% interest. Okay, this guy gets 8%, so his money doubles faster. So he gets about 160,000. So this guy, you know, knows how to play it right, then he gets 12%. So he's getting about 640,000. If you're somebody who's just, you know, putting your money somewhere else and not paying attention to the rate of return that is given to you, you're losing how much? What's the difference between $600 and 40,000? 640 and 40,000. Is it okay to lose 600,000? So to a lot of people, you know, what you don't know won't hurt you, right? But when it comes to money, it will definitely kill you, right? Because that's $600 right there. Where are you going to get that? See, this person just gave his money time. So we're going back to the concept, you know? That's why I told you, understand properly the concept. Understand the formula. So earlier, we said money plus what? Plus time. So this guy has $10,000 but gave his money time. And then the next factor comes in, which is what? The rate of return. So he look for something that will grow. Right? Because in the bank, how much do they give? Let's say a conservative 1% that they'll give you. 72 divided by 1 is how much? 72, right? How many 72 years do you have? So it's ouch. So just imagine, if this was your credit card, it's the same thing. Given 18% APR, 72 divided by 18 is how much? 4. So if you have a credit card with 18% interest and you keep on paying just the minimum and you keep on maximizing your debt, then your debt is bound to double in 4 years. And in the US, it's legal to charge up to how much? 30%. So it's basically doubling your debt in 2 years. So you need to stop using your card unless you're in business, right? Okay? So here's a golden nugget question. What will you do when you find a finance vehicle that is higher than your bank? What are you going to do? Of course, you need to do something about it. Okay? Change the way you think. Alright. Another concept about interest. Okay? So a lot of people, so a lot of you have 401ks, right? How often do you get your statements? Quarterly, annual, right? If you get your statements, you would probably see, let's say, a net 20%, right? So for people who doesn't pay attention, they will think that, oh, my money earned 20%, right? But, you know, you have to think about, like, where is your money being placed? Your money is in the market. So if your money is in the market, then there's a possibility of gain and what? Loss. So, let's say $100 that Mr. A and Mr. B has. Let's say Mr. A is very, very aggressive. So he places his money in the market, so he has a potential for maybe a 40% growth. But then, the following year, he lost about 20%. So that gave him a net of what? 20%. So same thing with Mr. B. Maybe is very conservative, so he just places his money where it will just yield about 10% every year. Okay? So lucky you if you could get these rates nowadays. Because it's very hard. Right? So, Mr. A, Mr. B both getting that 20%, but how come they're getting a different amount of money in the end? Because this is the actual run of your money. Interesting, right? So let's say, okay, I still don't understand it, you know? Because I saw my statement is 0, so I'm not losing anything. Right? So let's just say a 50% growth in your $100 will make what? Your $100. It will become what? $150, right? But if you lose 50% the following year, then how much is your money? It becomes 75. So for some people, they will think that it's still 0%, then they think it's still $100. But this is what happens to your money. Clear? You have to know it. 0 and 0. So Mr. B, this time, he was so scared to put his money in the market, so he just decided to keep it inside the house. Right? In a piggy bank. So 0% in the beginning, and then 0% is how much? 0. So, is that good or is that bad? Why? Because the money didn't grow. Right? So it's really something that you need to think about. Any negative in your money is what? It's against your money, your wealth building. It's very, very detrimental to your wealth building. So keep that in mind. So another golden nugget question will be, what will you do when you find a finance vehicle that doesn't go negative? So the first question was, look for something that is higher than your bank. And this time, you look for something that doesn't go negative. Okay, does that help? Alright, so the effect of taxation and inflation would be this. It's basically you looking for something that will yield about how much? 5%. Otherwise, if it's not, let's say a bank is how much? 1%. So, you're losing. Why? Because it won't keep up to the inflation and taxation. Very simple, right? So, another question here would be, what will you do when you find a finance vehicle that with at least 5% interest? Then you have to move over your money to that Okay? So if you have money that is not yielding 5%, if you have money that is always going negative, then if you have money that, getting just interest like which a bank is getting, then you probably would need to think about moving it, All right? So thank you guys for listening.